Hello, everyone. Welcome, welcome, welcome. We are so excited that we have Nathan Turner here. Nathan has been in the note business for quite a number of years, and there are so many different ways that you can buy, hold, sell notes. And Nathan's going to talk about a few of them, and then we'll give you the opportunity to ask some questions. Thank you, Nathan, so much for coming on.
Oh, it's my pleasure, you bet. So I'm just gonna assume I'll assume that nobody knows anything about notes. So we'll go from there. I don't want to talk over anybody, but I hope it's not boring either, in case you do know something about notes. So when we're talking about notes, we're talking about mortgages. So a mortgage note. So when I'm buying a mortgage, what I'm actually purchasing is just the paper, just the IOU that the person has signed in order to buy that property. So if you think of your own situation, most likely you went to a bank to get financing to be able to purchase your house. And then in that process, the bank gave you money, and in exchange, you signed a bunch of papers that said that you would pay back the bank plus interest, and whatever interest rate you were able to negotiate at the time. And that's it. When I'm talking about buying notes, I'm talking about buying that paper. So the thing, when I first got started in this, and I got started in 2008, I bought my first non-performing in 2010. And at the time, the thing that I really kind of had to get my head around is that I'm not buying the property. I'm concerned about the property, and I want to make sure I understand what the property is, where it's located, what its value is, things like that. But I'm not actually buying the property itself. The name on the deed, the person on the deed is the borrower. That's what I usually refer them as, is the person living in the house is the borrower. And when I buy the note, I become the lender. So it puts me in a great position, because when you're talking about owning a property, and I think probably most of you have come from some kind of real estate background, and myself included, is when you're talking about a property, you've got the bricks, you got the sticks, paint, carpet, all that good stuff. But at the same time, you also have the trouble that comes along with being a landlord, where you've got the phone call at 2 a.m. where the toilet is jammed, or you've got something fell on the roof and now you've got to fix it, or you've got termites that have taken over and starting to eat away the house. As the bank, I don't care. None of that is my concern. I'm just the lender. So I love being in that position where I control the property, but I don't own it. And so that's a really nice position to be in. So that's at the very basic level, that's what I'm doing. When you start talking about what notes are out there, there's all kinds of different kinds. I like first lien mortgages only, and what's called a contract for deed. That's kind of the most well-known name of it. It's called different things in different states. Contract for deed, bond for deed, land contract, agreement for deed, all those things are the same thing, but just to make one name, we call them contracts for deed. The difference in that kind of a contract is when I buy the loan, I'm actually also buying the property. So that one's a little bit different, where the name on the deed actually does transfer over to me as the lender as well. So the borrower is still making regular payments with principal and interest, the same as if it was a mortgage. But the difference is my name is on the deed. And then once the borrower makes all of the payments that were contractually obligated in that contract, that is when the deed transfers hands. So in that case, I actually like those as well. That's how I got started in notes, was creating those seller finance deals where I owned the property and I was selling the house with terms, and people could then go move into the house, mostly because they didn't have the right kind of credit. And that was way back when, before Dodd-Frank, before all these great things that came into play, and it was very easy to get those kind of deals done. Now there's a few more hoops to jump through, but it's not the end of the world. I still do originate loans on a fairly regular basis. So I'm seller financing properties that I have taken back through foreclosure. So one other thing, maybe before I open it up, or if there's any clarification needed, there's so many things I love about notes, and one of those things is just the flexibility that it gives me. So I don't own the property, but I could. So because I'm in first position, there are very, very few things that come ahead of me. So in the case of the borrower is not able to make payments for some reason, usually that's divorce, loss of job, or death. It's not uncommon where I'll buy a note where the person has passed away. So of course, in that case, they're not going to make payments. So I can take back the property in a number of different ways. Foreclosure is the most well-known, and I certainly foreclose on a number of properties every year, mostly because the property is already vacant. It's not my favorite thing to foreclose on an actual person. I don't like doing that. At the same time, I'm not afraid to. If they are not making payments and they're not willing to make some other kind of arrangement, or if it's just not working, then yes, we'll go ahead and do the foreclosure. So foreclosure is one. We can do a short sale. So you probably have talked about and learned about short sales. In this case, I'm the bank, so I can actually encourage the person to sell their house and pay me off, which is really nice. So I know one of the big challenges with short sales is getting that approval done with the bank. I am the bank, so I get to approve that before we even start. So that makes it a lot easier and faster and much more efficient. I can do a payoff, maybe a short payoff. Like, let's say the person owes, for easy numbers, we'll call it, they owe $100,000 on their house. Maybe that's too big of a number to imagine, but essentially, if we agreed that for whatever reason, I would allow them to pay off the loan if they paid me $75,000. And that would work because maybe I paid only $60,000 for that loan. So there's still a spread in there that I can make some money. And those are very general numbers, but just to give you an idea of what that might look like. So those are different ways I can take property back. I can modify the loan in so many different ways. And that's a lot of fun, where we get on the phone and I say, okay, so your payment at $800 at, let's call it 8% interest wasn't working. Now, what could you do? What kind of payments would make sense for you? And maybe they'll say, okay, well, I can do $600. And I say, okay, the only way I can do 600 is if we raise that interest rate actually and make it 9% over a longer period of time. And we just kind of go back and forth and negotiate and whatever is going to work for both. As kind of like as a company policy, I say that my lowest interest rate that I will accept is 8%, just because I don't want to accept less than that. So and then that's, my company policy. So that is part of our negotiation. And that's a big one. And then once it's modified and if they're making payments, I can keep that for the life of the loan, or I can resell that at a less discounted rate to another investor or back to a bank even. And I've done both of those things. So that again, this is, high level, very general type stuff. And I'm more than happy to go into details if you'd like and give you some examples, but that's very, very basic. That's notes in a nutshell. What I do now is for the last, 7 years or so, 7, 8 years, something like that. I've been working with investors just on a joint venture agreement. Just last October, I actually opened a fund. One of the main reasons for that is once I'm up past 20 investors, the administration on my side becomes very taxing, where I'm having to prepare different statements for different investors every quarter, and it just becomes a lot of work. And my wife does a lot of that, and so she was kind of sick of that and wanted something different. So we opened up the fund where everyone's just getting a flat rate. That was another big change for that. The JV partners, one person would be doing well, somebody else would not be doing as well. And frankly, they didn't know each other's rate, but I knew, and it was driving me nuts. And I don't like, having that out there, that somebody who's doing better than somebody else, both invested with me. So that was another big reason. We just went to one flat rate. We're doing an 8% preferred rate of return for investors. If this was 5 years ago, I'd be more inclined to do some kind of a profit split. But in today's market, I'm not sure that's the best course of action. And I want to make sure that I can, meet my investors' expectations and make sure everybody's happy. So we've opened up that fund, and we are just raising capital for that now, and looking forward to making a whole bunch of purchases here this year. And once that fund is full, then we'll open up a second one, and we'll just run 2 funds back to back. So that's my very brief introduction of what we're doing and what Notes are. And I'm more than happy to take questions or however the conversation needs to go.
I have a question.
Yeah, sure.
I heard you earlier mention non-performing notes. So
Yes.
why purchase non-performing notes, and what are they? What's the benefit of having them?
Great, excellent question. So technically speaking, if a mortgage goes unpaid for 3 consecutive months, that's considered non-paying. If they pay, and we get this all the time, where they pay 1 month and not the next month, but then they make it up the following month, that's what we call subperforming. And if they're making regular on-time payments every month, on time, by the way, just meaning that they've made the payment sometime in the calendar month, that is considered current. So those are performing notes, subperforming, and non-performing. For the non-performing, part of it is I like the challenge of it. I like that it's different every time, and it makes it fun and interesting. But the biggest reason, obviously, is I can get a bigger discount on the non-performing, so my upside is bigger. The risk is that it can take more time to work something out. Part of the risk is if I take back the property, usually taking back the property is my most risky outcome, just because we're the bank, we're not able to get inside the house before we buy the loan. So there's always that risk that the inside of the house is not in good condition, and then that's not good. And it happens every once in a while. It's not common at all, but it certainly does happen, and that's the risk of that part of it. So our main goal is always to get people paying again. It feels good, and it's nice to be able to help that way, and B, it actually is the most profitable solution. So we're always trying to get people to make payments if that's possible.
So it sounds like you do both contract for deed, and they also have people also have title. So you have to deal with doing a foreclosure or doing an eviction, it sounds like.
Right.
I'll tell you, Jimmy Napier would be very proud of you. I miss him terribly, very much, but he is the reason that we are where we are today because of Jimmy.
Absolutely.
I went out to Florida and did I did many of his courses. Invested Debt taught me a heck of a lot that I didn't know.
His book was actually very difficult to find, and I wanted to have it mostly just for those base principles, because I know he's kind of the godfather of notes. So I wanted to have his book, and I've got that on my shelf, and I'm a proud owner.
Me too. Me too. Yes, it's a great book. Actually, you could get it now because I can't remember his first name. Johnson went in and started working with Jimmy after he had a stroke and got him to publish the book. And now it's actually available on Amazon, and it's called,
very good.
It's called Invested Debt by Jimmy Napier.
Great book. Absolutely.
Yes.
Joseph has his hand up, and Seema does as well.
Hey, Joe.
Joe.
Joe, you're muted.
You there, Joe?
We can't hear you, Joe. Now you're muted again. So
Am I unmuted now?
You're on.
Oh, okay. If I'm not too echoey, this was such a coincidence because Nathan and I met at a few shows, and and I didn't know who Nathan was. And I popped on. I was like, "Oh my God, so Nathan, I know." So Nathan, hi.
Hey,
Okay, I want to ask a question. This just came up at a meeting I was at, the Phoebe meeting a couple nights ago.
sure.
And what I heard was that there was one of the bulk sales or auctions that, Fannie or Freddie, and that these hedge funds were buying up those non-performers almost at no discount. So my
Yeah.
question is, as those start to filter down to like yourself and some of the other secondary market, do you think that's going to affect the discounts that the notes are available? So if we're buying not either non-performing or reperforming, do you see that it's going to affect the pricing for the next few years if they're being bought so high?
Yeah, that's a great
Does
question.
that make sense?
Yeah, for sure. I don't see how it couldn't. I don't see how that couldn't come into play as it kind of trickles down. If they're paying par for non-performing, unfortunately, they're going to lose money on those. There's really no way around that. So that makes it tough when they're trying to resell, because of course they don't want to take a loss, but they're going to be forced to, and it's just going to be a matter of how big of a loss are they willing to take on those. So that's going to be tricky on those. At the same time, we had all kinds of notes that were like pre-foreclosure stuff that was accumulating before COVID. And then once COVID hit, everything just kind of stalled as far as the courts are concerned. And it's only just recently, for some states, even just this year, where the moratoriums have finally lifted and we can continue on with the foreclosures. So there's a big backlog of pre-COVID foreclosures. I had a couple of those that got stuck in there as well. And then I don't know that we're going to see a massive number of foreclosures coming out of COVID, but I do believe we'll see an uptick for sure.
What
So,
about
and
all that
thank you.
funding money, Nathan? All that funding
Sorry?
money out there, and they're just throwing money at stuff? Do you think
Yeah,
that would make a difference?
So it's fun for me. I don't know that I said this at the beginning, but I actually live up in Canada, just outside of Montreal. So I have the great blessing and privilege of being totally third party. I'm not connected to any political view, and I like that because it gives me a bit of objectivity that is hard to come by when you're in the situation. That being said, what I see is the can is just getting kicked down the road and kicked down the road and kicked down the road. And eventually it's going to come to a head, I think, rather sooner than later, meaning, the next 12, 18 months. And, I don't know, but I see that coming to a head at some point here. And that's going to cause problems for some, opportunities for me.
Go ahead, Joe. Sorry to interrupt.
Yeah, I'm so sorry. And now this is more of a double question. So that all said, do you have any, well, listen, let me ask it this way. Where do you think, for the investors that are on this call, for other investors who aren't full-time, where do you think the opportunity and availability is going to be to find? For example, I have an investor now who says I would like to buy individual notes. So I'm sure there's people on the call too. Where do you see the opportunities right now, other than the stuff that maybe was bought too high?
So like Joe, you've done this before, you know what you're doing. For somebody that's just barely getting started and it has some education, but not any experience, I would be very wary. I would say partner up with somebody who has done this before, so that you're not overpaying, or essentially what it boils down to is overpaying because of location or because of just the numbers, because of statute of limitations that are coming into play. There's all kinds of factors that if you haven't done this before, that's a danger zone. So I would recommend teaming up with somebody.
Thank you.
Real quick, to probably off of that, how do you determine the purchase price?
How do we determine purchase price? A range of things. So the way it works is I get what's called a tape, a spreadsheet. So I get a spreadsheet full of different loans that are available, anywhere from 10 to A larger tape would be something like 300 loans. Incidentally, years ago, 6, 7, 8 years ago, they would be more like 200 to 500 on a sheet, and that's changed. But then it comes down to whittling it down. So things that I do is I immediately filter by city and state, and then I overlook several states. I'm not a fan of New England. The foreclosure laws there are tough. They're very difficult to deal with, and so I pass those over just because it's not worth it. Next, I'm looking at things like interest rate. What's the current interest rate on that note? I'm looking at when's the last time they made a payment, or when's the next due date, because of things like statute of limitations. Different states have different statutes, and so that if I don't know, I'll go and look it up and make sure that I'm aware of what the statute is in that state and how that works. There are some where, let's say the last paid date was 2014. So we're talking about 8 years ago. Does that mean that I cannot start a foreclosure, or does that mean that I cannot collect anything prior to a certain date? And different states have different rules on that. And if that doesn't make sense, don't worry about it. But that's another thing I look at. I'll look at what's the unpaid principal balance. We call that the UPB. What is the total payoff balance? So total payoff balance would include the unpaid principal balance plus any arrears or any fees, anything that has been charged back to the borrower. Lawyer fees are often included in there as well if they've started a foreclosure. I'll look at that. Location is obviously important. A note in Michigan is going to be different than a note in Florida. And so there's a wide range of different criteria. So it's difficult to say, a percentage of unpaid balance or a percentage of value. Back in the old days, you could do that, but not anymore. And so just incidentally, one of the interesting shifts that's happened over time, which makes sense, is back in 2010, 11, 12, I think probably 100% of the time it was negative equity, meaning that the house was worth less than what was owed. And as time has gone on, starting in about 2018, that started to shift, where all of a sudden we were seeing equity in these loans, and that was a big shift. And so that changed the strategy on how you can bid on these and how much you should pay, things like that. So that all of those things. So that's a very long answer to say it depends, but that's why it depends, is because there are a range of different things that you need to consider.
Thank you.
Thank you so much for that.
Seema has a question, and then Brett, and then Nika.
Sure. Hi, Nathan. I'm a fellow Canadian from Western Canada.
Oh, right on. I grew up in Alberta.
Whoa, I am from Edmonton, or was.
Okay. I grew up in Lethbridge.
Oh, well, that's not far.
Not far.
That is cool. So there are a couple of people in the Sarasota area who do notes, and they also sell partials, because then they want to take some money out and do it. My question was, do you think there's going to be a lot of defaults coming up when people's money dries up?
Yes. Probably not 2008 levels, but yes, I think we're going to see a bunch of defaults happening here. And when you start talking about interest rates going up and things like that included in the mix, that may make it worse, and we'll see.
Okay. And also, do you have a minimum for your fund? And if you can somebody can put your contact info? Sure.
Yeah, our minimum investment is 50,000. Maximum is $1 million, in case you're so inclined. But yes, I can certainly.
And
I'll put my contact info in the chat for you.
That'll be good. And do you only take accredited investors?
Yeah, ours is, yes. It's a Regulation D 506C, so it's only for accredited investors.
Okay, because that's a huge problem for the people that I want to invest for. But anyway, so you do that. Okay, thanks. Oh, and you can have an LLC invest You know,
Yes.
the LLC can have as many members as it wants.
Yeah.
Okay, thanks.
Great. Thank you, Seema. Brett?
Hey, Nathan, this is good stuff. Thank you. You
Hey.
kind of already covered it, but I wanted to perhaps ask you to speak more on the due diligence. And you mentioned about, you know, your 8% minimum cutoff. You won't take anything less than that. What other kind of, you know, general rules of thumb? I know there's the 1% rule, there's the 70% rule of the ARV for flippers.
Yeah.
You know, and we kind of have these other golden rules, and if you could speak to that a little bit, some of the, you know, the red flags, the things you stay away from, and perhaps also why you have come to those after so many years. I'd love to hear about, you know, the motivations and, you know, your hard and fast rules that you have, and also your rules of thumb.
Sure. So part of my due diligence, one of the great things that I like about this is, especially if I'm buying one-offs, if I'm just buying one or two at a time, it's real easy to do a bunch of due diligence for free, which is really nice. So things like, I'll look at that, if we go back to that list that I'm looking at, oftentimes, you know, it'll come up with a city in a state that I'm not familiar with. So I will go and Google the name of the city. And if the city or town, as the case might be, it has a population of less than 20,000, then for me, that's a pass. Just because there is a good chance that I'm going to take back this property. My parents moved at one point to a little town of 5,000 people. And the joke was always that, you know, I don't remember the name of the people that lived there before, but, you know, the Johnsons. So it was never the Turner's house, it was the Johnson's old house. And it, you know, is kind of always viewed that way. So they had stories of they'd be in the living room with the windows open, the curtains open, and people would literally drive down the street and slow down and look to see what the Turners are doing in the Johnson's old house. And so it was that kind of thing. It makes it difficult for a good real estate market to happen. And so that's a pass for me. So small towns is a pass. Another big red flag is low interest rates. And Peggy and I were talking about this just briefly before we got on. If you're creating a note, please don't do a low interest rate. Like I say, my company policy is 8%. If at any point you're looking at reselling that loan, if you've got a low interest rate, the buyer is going to be looking for a certain yield or a certain return on that. So if you've written in a low interest rate, you've really shot yourself in the foot. You're going to have to take a huge discount to be able to meet the buyer's projected yield on that. So it happens again when I'm looking down that list. Interest rate is at 3%. And the last time they made a payment was 6 months ago. So the chances of that person repaying are pretty high. I don't want them to if it's only a 3% interest rate, because there's no money in it for me. So on that kind of case, I would pass on that as well. So those are a couple. Small towns, low interest rates. I guess little numbers is kind of the common theme there of things to watch out for.
Mika?
Oh, yeah, you mentioned that you're in first position. Is there anything that can knock you out? Like meaning can a tax lien supersede you if they started the foreclosure before you and knock you out of your first position? What can knock you out of first position?
Yeah, there are not a lot. Taxes is one. And you know, the things you learn. So a quick story on that. My very first note purchase in 2010, there was a package of 3 notes. The first 2 went great. That's fine. The purpose of this story is the third one. It was a house that had a fire. It had mostly burnt down. It was in Columbus, Ohio, near the university. So the plan was take back the property, knock down the existing structure, build something that could be student housing. Great plan. The problem was I had paid 10,000 for 3 notes. So in essence, I paid about $3,300 for this note. What I found was there was about a $10,000 or $12,000 tax lien attached to the property, and they were about to start foreclosure. So if I wanted to save the house and take it back, I would have had to pay the additional tax lien that was on there. At the time, I didn't have the resources. I didn't have the team in place to be able to build what I wanted to build. So I had made my money on the first 2 notes. On that third one, because I didn't actually own the property, I didn't technically owe those taxes. So that was a big wake up call for me, just to say, okay, this is awesome. So I'm not directly responsible for these taxes. So that was a big aha moment for me back then. So all that to say, taxes is one that can knock you out. City liens will come before you. So if there's weed abatements or something like that, and they've tacked on interest, and depending on the area, $100 a day fines, that comes ahead of you as well. So that's another thing to be very aware of and make sure you know. In certain states, HOA liens will come before you, but not everywhere. So that's something you need to check. As a rule, I don't usually buy condo liens, condo loans, but if I do, that's certainly one thing to check into. That the HOA liens can be a difficult one because it will not necessarily show up on a regular title search. You have to make a separate phone call to the HOA association to find out about the lien, how much it is, and if they're willing to take a discount, anything like that. So those are tricky ones. And then IRS is debatable. I've had some attorneys say yes, I've had other attorneys say no. So that one's a bit of a gray area, and it depends. One that I passed on years ago, I remember I got the title report, and on there it said it was like a $60,000 lien, and the name attached to the lien was United States of America. And I went, oh shoot. I came to find out that was something from the Department of Justice. And so I passed on that because I don't even want to attempt to deal with that kind of a lien and suggest that maybe they don't deserve to receive that money. So I passed on that one. But only those. Yeah, I mean, I give you a bit of a list, but it's really, essentially, it's not that many. And most of them you can find out about beforehand. So that factors into your pricing, where if I see there's a $3,000 tax lien attached to the property, that's not necessarily a deal breaker, but it may mean that we need to negotiate on the price of that particular loan. So that's the long answer for you.
Thank you, Nika. Cliff, and then Doug.
I had a question on the different components of a note, the front end, the back end of the note, or different parts of the note, and the advantages and disadvantages of each part. So if you're purchasing partials.
Yeah, good question. So if you think back to your own mortgage, if you look at your statement when you very first got your mortgage and you started making payments, that first year you get the statement from the bank and it says you paid off $300 of principal, and you go, what? I paid like $10,000. What happened there? And that's how that goes. So at the very beginning of the note, you're mostly paying interest. So you're paying interest, a larger chunk, and principal, a smaller chunk. And as time goes on, that changes. And eventually you'll be paying more principal and less interest on the back half-ish of the note, depending on the term and all those kinds of things. But so that first half is mostly going to be interest. So when you're looking at buying a partial, and that's kind of a different animal, but if you're talking about buying a partial, for you, if you're just buying the first 5 years, it doesn't matter as much because you're just buying an income stream for however many years, 2 years, 3 years, whatever it is. So that portion isn't as relevant to you as the purchaser of the partial. For the one who sold you the parcel, that's a little bit more crucial because they're left with whatever's left after the partial runs out. So does that answer the question? Or is there more to it?
Yeah, so it sounds like that they're not receiving that income if they sell that partial. So if they sold the first 5 years of a note off to someone else, the person that purchased the first 5 years will receive the income from it, but the person that sold it would not. So what they're really banking on is the fact that the note will actually carry past the 5 years and they'll continue to receive income at year 6 going forward.
Right.
Okay.
Could I interject a question on that, please,
Sure.
Doug? Sorry to. So if, like, I have a loan, I pay extra principal with every, how's that going to affect after the first 5 years, the person that has remainder?
What all it really affects, well, all it really affects is the time on that loan. So by paying down principal in that first part of the loan, you've shortened the term. So instead of it being, fully amortized over 30 years, it'll shorten up to 25 years or 23 years or something like that. So for the person that sold the partial, that could really affect your return over time. So yeah, something you definitely want to consider and make sure you are aware of, the risks in that way.
Thank you. Doug?
Okay.
Yeah, so actually I was going back to your previous discussion about the interest rate. I want to make sure I understand what you're saying, because let's just say for me, last year I refinanced, or I guess it was at the end of 2020, I refinanced for like 3%, right?
Yeah.
My mortgage is at 3%. Then I lose my job and I begin to struggle.
Yeah.
Somebody picks up this note. Are you saying that you wouldn't want to pick up my note because it's only at 3%? You would want someone who had a higher interest rate, or are you speaking of something else altogether?
No, great question. And me personally, no, I would probably pass on that. Just because I'm looking for a higher rate of return. My money is costing me 8%. So if my money only cost me 5%, maybe I'd be more inclined to purchase that. But I'm having to make up that gap. It's a bigger gap with the lower interest rate.
Okay, so now what do you mean by that? Your money is costing you 8%. Or you picked up a hard money loan or something like that in order to purchase my note?
No, so my fund is paying out 8% to my investors.
Gotcha.
So essentially it cost me 8%, a little more when I factor in my cost of the company. But I need to take that in consideration when I'm looking at potential returns.
Gotcha. Okay. Oh, so then final question on that then, with interest rates being low, they've been lower than 8% for a while.
Yes.
How are you guys able to pick up additional notes? More than 8% on a mortgage right now.
Yeah, that's a great question. It's interesting. I get sent these lists, and it's actually rare that I come across an entire list of low interest rates. There'll at least be some in there, half, where they're going to be at least, 6, 7, 8%, which is something I can deal with. The other part of that is I'm looking at occupied and non-occupied. So if it's at a 3% interest rate, but the house is vacant, then sure, I'll go ahead and buy that loan. What I'm afraid of is it's a low interest rate and the person starts making payments again, then I'm stuck, because contractually I have to accept, if they make up their arrears and they start making payments again, I can't just go in and say, oh, sorry, you've got to pay 8% now. I'm bound by the same terms that the borrower is bound by. So that's, kind of the catch-22 on that. But if it's a vacant property or something like that, or if they haven't made payments in the last 6 years, chances of them catching up, all those payments are pretty low. It's more likely that I'm going to take back that property in one way or another.
Okay. Okay. So that's the reason why you would take it if it was vacant, because you're looking to foreclose on it.
Yeah.
Got it. All right. Hey, appreciate it.
Yeah, you bet.
Thanks, Doug. Cliff, and then Lisa. And then
Couple of
Peggy.
questions.
Sure.
So I imagine that a fair amount would be seller carryback from other investors, or possibly where private money was utilized to actually loan out for a note or a mortgage. And then they typically do charge higher interest rates.
Yeah.
So how did Dodd-Frank change the structure of the seller's carryback? And so Peggy's shaking her head. So is that something you don't want me to go into there? I mean, it really, it muddied the water for a lot of investors. It really didn't help us. It just helped the banks ultimately. But how did it actually change the structure of what you're doing, you know, or what an investor would do with seller carryback notes when they structure them?
Sure. So the intent of Dodd-Frank was to protect the protect the borrower. And I totally get that. And I agree with that. And we don't want to be taking advantage of people because that's just not cool. And nobody should do that. So that was the underlying intent. The result was, of course, something very different. And again, Peg and I talked about this. Those who haven't done it, who don't know anything about it, should learn about the business before they start getting involved because they don't know what they're doing. So beforehand, it was interesting because there were very few rules when you were doing some kind of a seller carryback note. If you were selling it on terms, you could set the terms at pretty much whatever you wanted. So if you wanted to set that at 15%, set it at 15%. And that's, you know, go for it. And in some states, you can still kind of do that and in certain situations, but that's next level anyway. But essentially, again, when it boils down to, you know, brass tacks, after Dodd-Frank, really what it came down to is you have to prove the ability to repay. And that's really what it boils down to for the borrower side is I have to, if I'm going to be providing seller financing, I have to prove the ability to repay. So I have to then go back to the borrower and get the last 2 years of pay stubs. And I have to get the last 2 years of W-2s and whatever they can prove, whatever social assistance they're receiving, anything like that, whatever income they have has to equal, I believe it's, I don't do it myself, so I couldn't tell you. I use an underwriter that's licensed because that's another requirement. I can't do that on my own. I have to use a licensed mortgage originator that analyzes it all. And I think it's 1/3 of their income, but I don't know the exact number if that's it or not. But that's what it boils down to for the borrower. On my side, the frustration is that, again, in trying to protect the borrowers, and I get that, but misstep. I'm only allowed to originate 3 loans per year without doing the underwriting. So, for example, and I actually do this because let's say I've got a borrower. Here's an example. I had one in Mississippi where the borrower came to me and we had the house listed. It was $100,000. I just wasn't selling. I was hoping just to sell it to a local investor to pick it up and do whatever they're going to do with it. But it wasn't selling. So I offered seller financing. And I had somebody coming in that had 20% down payment, which is actually double what I typically ask for. I usually ask for 10%. They had $20,000 to put down. The catch is they did not meet the requirements according to the underwriting standards. However, again, I called the landlord. They were renting beforehand, and I called the landlord as a reference and just asked, you know, can you tell me about this person? How are their payments? And they had been in that property paying more than what they were going to be paying me, and had made payments throughout and never missed a payment, and all through COVID. And the landlord was sad that they were leaving because they were the most solid payers that they'd had, and on and on and on and on. And so I went, okay, $20,000, great reference, but they don't meet the required underwriting. So for me, I had only done one other non-underwritten loan that year, so I can do up to 2 more. So I was happy to take her $20,000 as a down payment with this great reference. And sure enough, she's been making every payment since. This has been 6 months now, and I have no complaints. So great, but I'm limited to only doing 3 of those in a year. And again, I understand where they're coming from, and that's great, but it limits me in my ability to help people, which is frustrating.
Can you do that under different entities as a way to work around that?
No, they've
Okay,
buttoned
all
it
right.
up pretty tight.
Okay.
So I don't know if anybody here is aware, there is a seller finance coalition and they're lobbying constantly. Jeff Watson is part of that team, and they're lobbying and trying to get that changed. And they're making some headway, but you know, it's Washington, so it's very, very slow.
Thank you, Cliff. Lisa,
Hi.
hi.
It's very this is new to us. Kind of my husband Angel is also on the line with me.
Well,
Great.
nice to see you. Yay.
Sorry. Hi. We're here. We're in the fund that you have. Do you only carry like mortgages or notes on single family homes, or do you also carry commercial or like apartment complexes and all that stuff?
Yeah, I only do single family, mostly just because that's what I'm familiar with. I would hesitate. I would want to do it on my own first on some commercial or apartments or something, so that I know how they would fit in before I offered it to anybody else.
Okay. All right. Thank you.
You bet.
Wait, you know what? You're going to have that opportunity in a few years. As
Yeah,
we
I'd be happy
discussed
to.
Earlier.
Yeah.
You will be looking at a lot of multifamilies because I think they're going to be in big trouble in about 2 to 5 years.
Yeah.
Yes, I had some comments, and one of them was when we talked about the low rates. So any of you who are thinking about doing a carryback, and you say you'll do a carryback, and they say, well, the bank rates are whatever they are, your answer is, I am not a bank. I am a private person, and I don't carry bank rates. You want a bank rate, you go to the bank. You want to work with me, we're talking 10, 12, 15%, 8, whatever. You call someone like Nathan or some of the other people that we know, Joe and a few people, and say, look, if I were to create this note, what rate do I need? So Nathan, why don't you say, let's say I have a property, I'm going to carry back a note, but I'd really like to get my cash.
Yeah.
What kind of discussion would we have?
So my standard, like I say, 8% is my best rate. My standard is if I'm doing a seller finance deal, I'll do a 10% down payment, 10% interest rate over 10 years. And the 10, 10, 10. And then you plug that into your financial calculator if you know how, and if you don't, I can show you. But that's what I'm looking for, 10% down, 10% interest for 10 years. And what that does is not only is that a great return for me, but that makes it a very marketable note if I'm looking to resell it at any point. And maybe I am, maybe I'm not, but I'd like to have the option. So I want to just leave doors open, and in case I need to sell that, then I can.
And mind you, that's like 7% above the rate right now, or 6.5% above the rate right now. So
yeah,
remember, you are not the bank, and you do not have to carry bank rates.
Yeah.
That's set by the bank. And for the Dodd-Frank for Cliff, one of the purposes of the Dodd-Frank was to get rid of independent brokers. So a regular broker like myself could create notes, sell notes, do all of that with our license. But the banks did not want us there. So Dodd-Frank created that if you wanted to continue being a mortgage lender, you would have to go through this I can't remember what they called it, but I went through all of that and I got that license. And I'm like, I don't work with people that are going to move into a house. I only work with independent investors. So I didn't need that. I gave it up. I can't remember what that was called. But they wanted to get rid of people. They wanted to get rid of the brokers doing that. Banks wanted it. Banks want 100%. They want to monopolize and have complete control over the market. Fortunately, they don't.
So really quick, one of the loopholes, there are a few small loopholes, but one of the loopholes is if I'm lending to a company, no Dodd-Frank. It doesn't apply anywhere. So I can go ahead and set that 15% interest rate if that's what we agree to. So that's one of the few loopholes there are in that one.
Right, if you're lending to an investor, somebody that's a flipper, you don't come under that. Yeah, so that's why I gave up that license, because I didn't need it.
Yeah.
I'm in the investment world, as most of you are. So thank you very, very, very much, Nathan.
Oh, my
Is there
pleasure.
anyone else with a question or a comment before we're almost at the top of the hour, but I'd like anybody who's got a question to ask Nathan before we end. Nada. Okay, so Nathan, we are so excited that you came on and explained notes to us. I'm sure there's a lot more involved in it, and we'd like to invite you back at some point.
I'd be happy to, you bet. And that's my one and only real advice is if you'd like to get started, go for it. But at the very least, get some education. I don't do education, so I'm not selling you anything there, but it's not real estate. And so you have to know the difference. You can get yourself into a bunch of trouble.
That is so true. So thank you, and you can always call Peggy Beauregard and she'll point you in the right direction to get that
Okay.
education. Thank you.
Excellent.